An employee stock ownership plan is a retirement savings plan where the company contributes stock every year to your retirement account. And when the company does well and is profitable, the value of your stock can grow, meaning your retirement grows and your wealth accumulates. What's unique about an ESOP is the employee does not have to contribute to that plan. The company makes all the contributions. Because the value of the stock increases based on company profitability, this is a wonderful opportunity and responsibility for the employees by serving your customers, by bringing in sales, by cutting costs and meeting deadlines. Your company becomes more profitable. Therefore, your retirement account is bigger and you're growing more wealth. So it's a wonderful alignment of incentives for both the employee and the company to do well. One of the things that makes employee stock ownership plan financial planning different, or that makes financial planning different for ESOP participants, is there are rules around when they can sell stock back to the company. There are also tax considerations. If you're selling stock back at 55, the tax considerations are different than if you're selling stock back at 60. And the options of what you can do with that stock are complex. You can cash a check in your bank, pay tax immediately. You can roll it to another tax deferred account. In addition, there can sometimes be timing delays. You might fill out some paperwork and get it back to your ESOP plan administrator, and you could get a check in 3 weeks, or you could get a check in 12 months. Every plan's different, and that's where professional guidance can really come in and assist someone. Further, because you're working in an employee-owned company, you're working there, you're accumulating wealth with the stock, so you've doubled down on your income and your wealth accumulation. So it makes it really important for employee stock ownership plan participants to also save outside of the stock plan. Most employee stock ownership plan companies are very well run and have good returns on their stock. But once in a while, there might be external forces like what we saw in COVID in the travel industry that can harm that stock. So it creates a really unique planning item for these folks to save outside of that stock plan as well. When you decide to retire from an employee-owned company, there are rules and guidelines in the plan documents that have to be followed. Usually, you will state your intention to retire and fill out a form saying you're going to retire and leave the company. And the company, each one has different payout schedules. Some companies will pay out the balance of your employee stock ownership plan in one lump sum. Other companies will stretch that out over 5 years. So the timing of the payout and understanding whether it's a lump sum or multi-year is important. In addition, when you fill out the form and declare your intention to retire, there's a plan cycle year and an administrative piece to actually affecting these payouts. So depending on when a plan year ends, you could have a 1 month delay for getting your lump sum payout from your ESOP, or you could have an 18-month delay. So it's really important to check with your ESOP plan administrator or have your financial planner check with them to make sure you understand the timing. This is really important if you don't have other funds saved up and you're counting on that money for your first living expense right when you retire. Employee stock ownership plans were never intended to be the sole retirement savings vehicles for employees. Companies make those contributions, and many employee-owned companies are very well run. But unfortunately, just like the public sector, there have been notable failures. A few years ago, Silicon Valley Bank went down, and people had stock in that company, and they were employees and lost the money that was invested. So again, many are well run and do quite well. But keep in mind, anytime you have stock in a company where you work, you've doubled down on getting your paycheck, maybe your health insurance benefits, as well as building wealth in that retirement account, even though you didn't make the contribution. So as financial planners, what we do is we look holistically beyond the ESOP plan. For example, maybe you have a spouse or partner, perhaps they have a pension, or maybe your employee stock ownership plan company, your ESOP company also has a 401k plan. We would encourage ESOP participants to the degree that their budget allows to also contribute to a 401k plan or an individual retirement account. So you've got not just the ESOP that you're relying on, you've got multiple sources of retirement income that you've saved on your own and your spouse or partner has saved on your own. So you're not just relying on one single source. A smart diversification strategy would include looking at the assets you've accumulated to date, your 401k, your IRA, what your partner has, what your spouse has, and your ESOP account as well, and looking at that nest egg and forecasting out what your retirement income could be from that nest egg. And then if you're satisfied with that retirement income forecast, that might say to you, hey, I'm going to take these chips off the table, sell this company's stock back, put it in a diversified portfolio. Why would I do that? Concentrated activity builds wealth, diversification protects wealth. So you sell back some company stock, remove that concentrated risk, you have a more diversified portfolio, which gives you a higher likelihood of steady retirement income. The mechanics of that are you fill out a form to the company, say, I would like to sell my company stock back. You say how much you want to sell back. Maybe I want to sell back 1/5, 20% of my stock. And then you tell the company, I'm going to direct that stock to my individual retirement account. I do that. It's a tax deferred account, the ESOP, and it's a tax deferred account in the retirement account, the IRA, which means you only pay tax when you spend that money down the road in retirement. The second option is you get a check, you take that check to the bank, but you're going to pay regular income tax that year when you cash that check at the bank. A lot of folks don't realize that if that is a very large ESOP check, let's say it's $900,000, all of a sudden your income's gone from, as an example, $150,000 to $1,050,000 in 1 year, and you're in the massively highest tax bracket. So you can be caught unaware if you don't think about these different tax considerations in addition to the timing and whether you should diversify. When ESOP participants are thinking about retirement planning, it's important to not only focus on the stock account, it's imperative to look at what you've saved in your 401k. If I were talking to a younger employee owner, I would say, in addition to the company contributions to your ESOP, put as much money as you can in the 401k account every year. Why would I give that advice? Just in case your ESOP doesn't do well, and I'm not saying that's going to be the case, you want a nest egg that you've saved on your own, so you're not solely reliant on that ESOP. In addition, perhaps you have a spouse or partner. We want to consider what they can save on their own. Maybe they're a firefighter and they're going to have a pension. So looking at all the different pieces and not relying on one single source is very important. You may or may not have read that Social Security in the US could have some shortfall starting in 2033 or 2034. Can't say for sure if that's going to happen. Hopefully that will get fixed. Congress has done a lot to help retirees, but even just relying on Social Security, which is a government-run program, if you only rely on that, you might wish that you had saved in your IRA. So looking at retirement and having as many legs of a stool as possible to support your retirement is very important. So usually we'll talk to a participant when they're 50 or 55, and they'll say, hey, I've got a 401k, my wife has an IRA, or maybe my wife's a school teacher and she has a pension, plus there's this Social Security that might be here in 20 years or not. Peter, can you help us bring together all these disparate pieces of my financial life and forecast what my wealth is going to be when I'm 60, 65, or 70, but also how much steady income I can generate. And oh, by the way, figure out my taxes. So look at my after-tax income in retirement and help me project, should I sell my stock back? When should I sell my stock back? What tax decision should I make around selling my stock back? And can I meet all my goals? Can I pay for the wedding for my daughter? Can I buy that second vacation home I would like? Can I leave the legacy, the wealth I'd like to my children? So we do the planning to answer those questions and give employee stock ownership plan participants confidence in their future. And it's not just the financial future, it's the peace of mind that comes from knowing they have the highest certainty to meet their goals where feasible. Subscribe to this channel and visit peakwealthplanning.com.